Well, welcome to the final day of Pensions Awareness Week. This morning's session is on what risk category am I and why. My name is Fergal McKenna. I'm head of corporate at online investments and pensions advisory firm moneycube.ie. This is the first time you're tuning into one of the Pensions Awareness Week sessions. There's about 30 going on during the week on all sorts of topics on how to get started, investing your pension ethically to approaching retirement. And it's the aim of Pensions Awareness Week to try and demystify pensions and help people take more control of their finances. So why is the risk of topic, or the topic of risk, should I say, an importance when it comes to your pension? Well, if we take a lump sum of money today, we're investing that with the intention that it's going to be worth more in the future. And the level of risk that you take today will depend on how much more that's worth. There's potentially a significant variance to people's wealth if they over or underestimate the tolerance to risk over a long investment period. And when it comes to investing, there's lots of decisions like how much should I invest? Should I get help? Who can I trust? What asset class should I put it in? Which fund should I put it in? And then there's the paperwork. And one of the pieces of paperwork you'll be asked to complete is a risk assessment questionnaire. And by the time you get to the paperwork, it's natural enough to be a bit fatigued with the process, and it's possible the conversation on risk may not have been given the attention it deserved, and life just gets in the way. And just because you like to take risks from a day-to-day perspective in your sports or hobbies doesn't mean you do or should take risks with your investments, or you may be a risk-averse person, but you may have a tolerance for taking risks in investments. If it's a short-term investment, it's probably not as important, but the results of a risk assessment could have a material impact on return, particularly over an investment in something longer, such as your pension. And that's likely to be the longest investment horizon for most people. Knowing your own attitude to risk and checking if your investments match with that is important if you want to maximize your return or minimize your loss. I'm delighted to be joined today by Judith Casey, who works in investment solutions at Standard Life. Hi, Judith.
Good morning, Fergal. How are you?
Great, thanks. So I guess first off, what exactly do we mean when we refer to risk?
Well, yes, thanks for that intro, Fergal, and good morning to all our viewers. So yeah, there are a couple of different types of risk when it comes to investing, such as inflation risk, market risk, currency risk, but in general terms, investment risk is the probability of incurring losses relative to the expected return on the money you put into your investments. So different types of investments carry varied degrees of risk. So when you're deciding on what to invest in, you first have to consider what level of risk you're happy with, or what's your risk tolerance, which is a measure of your emotional response to changes in value of your investment. So everyone has different risk tolerances. Some enjoy speeding down the side of a mountain on a bike, while others prefer the lower risk of a leisurely cycle in the park, and some prefer no risk at all, so not even getting on the bike. So we all have different attitudes to investment risk, but the important thing to remember is every investment carries some degree of risk. And the key is to find out what degree of risk are you comfortable with, and this is where your financial advisor can help.
Okay, and I guess the advisor takes a look at the overall financial situation when analysing somebody's risk tolerance, and it's fair to say that the results of a risk assessment are used more as a guide, and they're kind of, they're measured against other investments, how much growth you're looking to achieve, and how much time you have to grow it. I mean, it's probably worth saying as well that there's a difference, isn't there, between volatility and permanent loss of capital, and these are routinely kind of confused. There's an element of inevitability with volatility, but permanent loss of capital would only occur when that volatility is in the negative. So volatility in itself is not a bad guy here. It really only impacts people's investments if there's too much volatility in too short a time frame. And it's probably worth mentioning as well that it's not just a case of just taking more risk. If you get greedy and end up taking too much risk outside your tolerance levels, the chances are you might panic and end up selling out at the wrong time.
Mm-hmm.
So how do we, I mean, the industry has a way of measuring risk. Could you talk us through that?
Yeah, sure. So the industry regulators have created an investment risk categorization for investment funds, and these are known as the Esma Volatility ratings. So Esma stands for European Securities and Markets Authority. Unfortunately, no one has a crystal ball, and we can't see how an investment will perform into the future. The only thing we do know is how a fund has performed in the past. So Esma looks back over the past 5 years' performance of the funds and calculates the investment's ups and downs, which is the volatility, and ranks it depending on how volatile the fund was during that period. So Esma 1 is ranked as the lowest risk, and Esma 7 would be the highest. So for example, an investment within Esma 1 may be a cash fund, Esma 4 would be maybe a mix between equities and bonds, and Esma 6 would be a fund investing only in equities in a particular region, such as China. But just a caution, a note here that considering Esma alone can be misleading. Esma does not tell you about the maximum drawdown of the fund.
Okay, and maximum drawdown, that's another one of those financial services terms.
Jargons, yes.
Yeah. Could you explain what you mean by that?
Yeah, so max drawdown calculates the difference between the fund's highest value and its lowest value, and it's basically the unluckiest investor in the fund. So it would be the investor who bought at the very peak and sold out when the fund was at the bottom. So it's really important to consider max drawdown also, as well as the Esma ratings. And also, it's actually worth noting, have these funds been through significant market events, through different market cycles, or has it only been around during a time when markets were doing really well? There are other variables that your advisor will analyze for you to help you give robust guidance. So this is all done behind the scenes, as supposed with you, and it's all part of the advisor service.
Okay, so that's the way the kind of industry categorizes risk. There's a way, isn't there, that there's a measurement of how people can find out about what their own attitude to risk is.
Sure, yeah. So if you're sitting down with a financial advisor, he or she will assess your current financial circumstances, and they carry out a fact find, which looks at your asset liabilities, your investment needs, and your financial goals. There's also a risk questionnaire, which helps you to determine your risk tolerance. So again, the industry and regulators have issued guidance. That means most financial advisors will provide you with the risk questionnaire, or you can indeed do it on your own. And these are generally a set of questions, and how you answer these questions will reveal your attitude or capacity for risk. So I've seen many people completing our risk questionnaire thinking, yeah, I'm a risk taker. But when it comes to investing for their pension or investing for the kids' school or college fees, they may not be so risky. And it's interesting to see the differences in attitude to risk when a husband and wife complete a questionnaire together. Often the results can be very different.
Sure, yeah.
So it's like, I don't know if you watch the cliff diving and the recent Red Bull diving competition down Patrick. So cliff diving is no doubt a very risky sport. But just because she's a risk taker in a sport doesn't mean she's a risk taker when it comes to investing. So she could be very cautious when it comes to investing for her future. And the same could be said for when you think about accountants or actuaries. They're perceived to be very conservative in their profession. But when it comes to their personal investments, they may be more savvy and perceive taking on more risks to be the right course for them. So generally, we see people having 3 buckets when it comes to their money, and each bucket would have a different level of risk. So if you look at your day-to-day bucket, this would generally be, what's in your current account, and you'd have no risk at all for this bucket. If you look at a 12-month bucket, this will cover your expenditures that you'd have on an annual basis, such as your car insurance, your holidays. So you probably don't want to take too much risk with this bucket. But when it comes to your long-term financial plans, your goals, you can afford to take a lot more risk with this. So investing, as you know, for pension can be for the longer term. So generally you take a bit more risk. If you're starting to save your pension in your 50s, you might not want to take as much risk. But if you're starting when you're 30s, you can definitely take a lot more risk with that.
Yeah. Okay. And I guess your attitude to risk is recorded at a point in time, and it reflects your view of life at that point in time, your emotional state, the timeline of investments as you spoke about, and I guess how financially comfortable you are And these things change, right? I mean, the world has changed for everyone in the last couple of years, and I'm sure that people's perception of risk has changed in that time frame. And I suppose that, leaving aside the changing factors in your own life as we get older and get more experience with investing, and learn more about it, our attitude to risk probably changes as well. I mean, there's this concept that, or this kind of common thought, that investing is risky, but when you get into it, there are elements of it that you can invest in a low risk way. So I think that with time, there's probably a better appreciation of risk. And I'd say as well, the criteria to test the tolerance for risk has probably moved on and probably getting a bit more sophisticated as technology comes into play. So there are, I mean, as you said, there's many different ways you can assess your risk, and lots of different questionnaires out there. What's the one that Standard Life would stand by?
Yeah, so you're right. There are a lot of questionnaires out there, and some are more advanced than others. So the one we use here at Standard Life is with Aura, which are Oxford Risk Research Analysis Company. So basically with this, you answer a series of questions which are designed to calculate your tolerance to risk. And as I said, this is a measure to your emotional responses to changes in the value of your investments. So there's 17 questions in all, and they assess 5 different risk measures. So you've got perception, so how you perceive your risk behavior. You've risk versus reward. How do you view the trade-off between risk and return? Future change, whether you're likely or less likely to be more or less risky in the future. The actual behavior, how you actually behave when investing, and the time horizon. So are you investing for a shorter or longer term? So it's good practice, we believe, to review this questionnaire when there are significant life changes, such as when the mortgage is paid off, when the kids are finished school, you don't have to pay the fees anymore, or when you're retiring. So all these changes would impact your attitude to risk, and you may wish to take more or less risk. And I suppose it's important to bear in mind, with all these types of questionnaires, they should be used as a guide, and your financial advisor will help guide you as to what the right investment is for your risk level.
Yeah, great. And I think in the past, these have just been kind of paper-based questionnaires, and as I said, people can be fatigued and kind of fill them out quickly or not pay too much attention on them. But I guess the technology is getting better, and Standard Life have an online questionnaire which can be filled out, and I think we're going to have a crack at filling out a couple of questions there, are we?
We are. Well, I'm going to attempt now with my technical ability here. So I'm just going to share my screen. So
with 17 questions, just in case viewers are concerned that we're going to be here answering 17 questions, we're only going to do a few of the last questions, isn't that right?
Yes, so we've completed the previous 15 questions with yourself, Fergal. So this is assessing your attitude to risk. So we're on question 16 now. So when you see this, it looks very busy, but I suppose really what I would encourage the viewers to do is, when you're doing a questionnaire, really sit down, give it time, don't rush through, really read the questions carefully. So this one here, it looks very busy, but essentially what it is, it's 6 different types of investments, one ranging from a low risk investment up to a high risk investment. And I suppose you're given a pot of 20,000 euros to invest. And it's really to gauge to see how comfortable you would be losing a certain amount and gaining a higher amount. So if we look at investment A there, that particular investment would be a low risk investment or no investment. So you have your 20,000 euros you've invested, and you'll get back 20,000 euros at the end of your term. So there's no risk really involved in that. On the higher side of it, if you look at investment F, that would be the higher risk investment. Of your 20,000 that you've invested, you could potentially lose 6,000 euros to bring it down to 14, or you could potentially gain a significant amount of money, bringing your initial 20,000 investment up to 52,000. So it's just a range there, just to gauge, to see how you would be comfortable with this particular pot of money that you're doing the questionnaire for. So, Fergal.
Yeah, Oh, well, this brings me back to kind of psychometric testing or something like that when I look at it. So, but it is important, isn't it, to kind of read the questions right, because whatever you decide here could have an impact on the output. And with 17 questions, it's pretty easy, I guess, to sway the output here. And that's the point, I guess, we're making for people during this session, is to really take a bit more time in analyzing a risk and know it well. So I guess, look, I'd probably I'm not as old as I look, so I've got a bit more time to go, and I guess I want to take a bit more risk. So maybe if I put myself in F there, I like the look of that upside.
Okay, thanks, Virgil. So moving on to the next and final question, question 17. Again, this does look very busy, but again, take your time in reading the question. So what we have here, we have 4 different types of portfolios ranging from A to D, and basically they're different investments over the performance of different investments over a 10-year time frame. So if we just look at portfolio D there, this particular investment has had a very smooth investment journey. You can see there's no significant peaks and troughs. But if we look at portfolio A, you can see that, yes, it has doubled its initial investment, but there have been significant peaks and troughs. So I suppose what this question is trying to find out with you is, are you willing to ride out these peaks and troughs, or where would you prefer a more smoother investment journey over this 10-year period?
Okay, yeah, that's a good kind of visual illustration of that volatility. I'd probably go for something like B.
Okay, so a couple of peaks and troughs. Okay, so now we'll just find out what kind of risk appetite you have based on the 17 questions that you've answered. So yes, you're looking like a medium to high risk investor, Fergal. So you've got a score of 134.5. So what this means is that you are in the higher risk category and you are relatively comfortable with investment risk, and you're aiming for longer term returns. You can also understand this means some periods of poor performance, but you're willing to accept some fluctuations.
Okay, yeah. And I would imagine, if you, like we said earlier, if you get some of those questions wrong, not that you can, but if you're not in the right frame of mind, or you don't take the time to read the questions, and you come out with a different risk category, your advisor who takes this information may end up, or you may end up, if you're working on these investments yourself, going into the wrong risk category, and I guess that's the next piece, isn't it? I mean, how do you link what the results of that risk assessment are with an investment that's suitable based on your attitude to risk?
Yes, so yeah, an advisor can definitely help you with this. And I mean, there are thousands of investments available, all with varying degrees of risks, and investments that are more likely to experience large changes that we've seen there in value over time are described as volatile, so that the serious fluctuations in returns, and they tend to have higher expected returns. Investments that are less likely to experience large changes in their value are less volatile, and they have lower and more stable returns. We saw there in the graph with the smoother investment journey. When comparing equities, properties, bonds, and cash, equities are generally considered to be the most volatile type of investment, followed by property, and bonds would be considered to be less volatile, and cash is generally perceived as the least. So when in choosing an investment strategy that's appropriate for you, it's important to balance the expected investment returns from an investment against its volatility, and considering both your risk and tolerance and investment goals. So the R questionnaire that you've just gone through, Fergal, measures your overall risk tolerance, and based on the answers to the questions, placed you in one of 5 risk categories. So there was low risk, low medium, medium high risk, which you came in, and high risk. So with the questionnaire that we use, your identified risk tolerance can be used across the multi-asset risk-based solutions which are available in the Irish market, and they're normally categorized in the same 5 categories as the risk questionnaire. So that will give you some guidance in deciding where to put your money. But I would again stress, you should talk to your financial advisor to make sure you're in the right investment for your attitude to risk.
Okay. And I feel like, might be using the word risk too much, but is there a risk in not taking on too much risk here?
Yes, and as I mentioned earlier, all investments carry some level of risk, and you might think keeping money on deposit carries no risk, but what happens if the bank defaults, if interest rates are negative, which they are now, or what happens in the purchasing value of your deposit in times of high inflation? So the more risk you take, the greater potential for gain, but hopefully also the greater potential for loss. So I'm just going to put up this slide here, which gives an indication of the returns generated from funds with different levels of risk and the power of long-term investing. So I've used a hypothetical 100 grand investment made 10 years ago into a select number of funds. So we have the cautious managed fund, the managed fund, and the European smaller companies fund.
Yep.
And this hypothetical investor stayed invested through periods of market volatility. And the returns speak for themselves. So, you know, you've got returns ranging from 99% up to 299%. And I suppose it's important to note that these figures are net of the IO management charges. So all in all, very strong returns.
Yep.
So this graph shows really that the different levels of risk you take with your investment will also dictate the different potential return you receive. So illustrated here, 100 grand investment made individually with 3 funds. The cautious managed is the lower risk of the 3. The European Smaller Companies Fund is the highest, and the managed fund sits in the middle, so it will be a medium risk level. So the higher risk you take, the greater the potential reward, but also, as stated, the greater the potential there is for losses. So these returns are obviously great for investors. However, you need to remember there were significant bouts of market volatility throughout this journey to get to the end result.
Yeah, but some difference between the two.
There is huge difference, yes. So that just really, I think it clearly shows the difference in returns in different risk levels. But just to put this into context, an investor in the cautious managed fund would have experienced a maximum loss from the top of the market to the bottom of the market of 21% during the most volatile period over the course of this 10-year period. So this is the maximum drawdown of the fund that we touched on earlier. Now, these losses increase as you go up the higher risk funds. So the managed fund investor would have seen a 25% drop in the value of their policy, while an investor in the European Smallest Company Fund would have seen a fall of 39%. So it's a good point to bear in mind.
Yeah, and I mean it's not just purely a conversation about risk, is it, Judith? I mean it's more about risk reward, and I think when we talk about pensions, people often have or should have a target for their retirement pot based on the lifestyle they want in retirement. And I think that's what's changing, is that the narrative on pensions is not save for your pension. It's like, what kind of lifestyle do you want in retirement? And people need to kind of visualize that in order to kind of to engage with their pension more. And so achieving that goal might mean questioning your level of risk tolerance, and having to decide between either dialing that up to achieve that goal or to adjust to a different level of lifestyle based on what the risk tolerance is expected to achieve you in terms of capital growth. And I know that's happening an awful lot in the space of an ARF, for instance, where people have a retirement pot, and they, instead of taking an annuity, are looking to convert that into an approved retirement fund. And just because people are living longer, and they want to maintain a certain level of lifestyle, they're having to consider taking more risk so that they don't run out of money, or bomb out, as the industry call it. Another one of those pieces of jargon. And it's not an exact science, is it? I mean, there's quite a bit of subjectivity involved in this, like what we showed there in the questionnaire. And I think that what we're trying to uncover here today is the balance between exposing yourself to unnecessarily to risk versus looking back in hindsight and finding out that, you know, perhaps you should have taken the opportunity to take more risk when you had the capacity to absorb that volatility.
Yes, absolutely. And I think just before I finish up for this morning's session, Fergal, I just really want to reiterate a couple of important points. I suppose the one is, number one would be invest. So you could be taking a risk by deciding not to invest, or by taking a risk by taking too much risk. So while most investments involve a degree of risk, it's important to realize that even deciding not to invest could expose you to risk. So your capital could be stolen, or its purchasing power could be reduced by an increase in the price of goods and services. So that's called inflation risk.
Sure.
Or how we saw from our earlier example, if you're investing for a significant amount of time, you could be taking a risk by not taking on more risk in your investment, which you just discussed there for customers coming up to their retirement. So the second thing I just want to reiterate is manage your expectations. People often underestimate the amount of capital required to live their lives. Again, what you discussed. This is really important when it comes to saving for your retirement. You're working, you've become to a certain way of living, a certain lifestyle, eating out, going on holidays. When you retire, you want to continue to do these and more so. So this means you really have to rethink your financial goals or the amount of risk you need to take on to continue to achieve your desired lifestyle. My third point, just to reiterate on, is diversify your investment. Diversification means spreading your money over a number of investments. You've all heard the saying, avoid putting all your eggs in one basket. It makes sense because it will reduce your dependency on one course of action, as you'll be effectively spreading the risk you are exposing your investment to. So this can be achieved by investing in different types of assets, as well as different industry sectors and geographical regions. Fourth point is balance and rebalance your portfolio. As a general rule, you should reduce your exposure to risk as you get older. As time goes on, your personal circumstances and market conditions will change, and this is likely to impact on your investment. So rebalancing your portfolio means that you need to review your investment to make sure that it's still suitable for your current needs. And finally, what I've been talking about for the last number of minutes, however long it's been, know your attitude to risk. Look at your existing investments, take a risk questionnaire. Do your current investments match your attitude to risks? Talk to your financial advisor. He can help. And I encourage you to re-engage if you have an existing financial advisor, or if you don't, set up a call with a new advisor. As you see in there, there's a lot of information we've covered, there's a lot of information on different types of investments to make. You need to ensure that you pick the right investment for the level of risk that you're in.
Yeah, thanks, Judith. And I mean, what you've spoken about, I mean, they're all kind of like an individual kind of simple points, but unless you're doing this on a day-to-day basis, it is difficult. And I can imagine how difficult it is for everybody.
Absolutely. Yeah.
So I guess at Pensions Awareness Week, we're all about action here. So if we were to apply what we've spoken about today to a list of things that could prompt an action by somebody listening out there, it could be that your circumstances have changed. You'd like to take a higher or a lower risk level than when you first invested. You might have started a family, or you're getting closer to a retirement pot, and your capacity to absorb financial volatility has changed. You might have better visibility of the goal that you have for your retirement pot. And I know that there's a couple of sessions on during the week on approaching retirement 1, 5, and 10 years out, and they are designed to try and give people kind of more visibility about what lifestyle they want. So it may be that's changed, and I think that I guess the other thing is that you may want to ensure that you've adopted a different approach to risk, such as that risk on for the longer term investments and risk off for the shorter term investments, like your rainy day fund, as you spoke about. And look, I guess perhaps there's no change required here, but people may get peace of mind by knowing that they're on track with where they want to be, or where their investments are linked or matched to their attitude to risk. So we hope this was a useful session for people to understand some of the investment considerations and what they should be thinking about. And no doubt your advisor is taking this into consideration, but this might provide the basis for people to have a better conversation with their advisor as well. Thanks, Judith, for your time, and thanks to Standard Life for helping us today in this session.
You're very welcome. Thanks very much.
No problem. And as always, the Pensions Awareness Week team are here to help you start, grow, and take control of your money. So if you have any questions, feel free to contact the Pensions Awareness Week team at hello@pensionsawarenessweek.ie. Thanks. Goodbye.